So tell me about your upbringing, where you grew up. I know you're from California. Before that, actually, maybe start by introducing yourself. Tell me, like, I don't know. Yeah, introduce yourself to someone who doesn't know you. I know you from your podcast. I met you on TikTok. But for someone who doesn't know you and who wants to learn, like, who you are,
sure.
Give me, like, a little bio.
Name is Sheetal Duggal. Basically, an investor based out of New York. Kind of technology focused with a general kind of bias towards public stocks, but have kind of done private stocks as well. Divorced, father of 3, and live in Manhattan. So
that's awesome. That's really great. You said you grew up in California?
I did. So I grew up in Los Angeles. It used to be pretty unpopular or not well known, but Kardashians made it famous. I grew up in Calabasas. So I went to Calabasas High. It's about 9 miles east of Malibu, about 20 miles north of LAX. Where I lived there until I was 18, and then moved to kind of Berkeley to attend school there, where I was an undergraduate business major. Graduated early, and started my career in New York shortly thereafter.
Why New York?
So I wanted to do finance. Finance was super important to me. I had friends that had done internships at places like Goldman Sachs during my college tenure, at least high school friends, and it made a real impression on me. I wanted to be a part of the excitement. I watched Wall Street. I'd consumed a lot of the media pertaining to Wall Street. I'd read a little bit about it. What really excited me about it was really hard to figure out. So it felt like this clandestine, covert, secret society that you had to kind of break into, and that just held a lot of intrigue for me. So, I grew up in a family where my mom was an accountant, my dad ran his own business, and they kind of looked at stock markets as speculation, if not gambling, and it was really important for me to kind of explore and see what that meant and what that looked like.
That's awesome. Clearly, that was a good decision. That's cool. California versus New York, what's better?
California.
California?
Yeah, I think it's pretty simple. New York, there's 2 things. One is there is this advantage with the time. If you work in finance, that you get 3 hours back, kind of.
So, in the morning. Yeah, I've felt that. I've done that.
So that's really important. And the second is you can't really beat the weather in Los Angeles. So when you think about quality of life, I would say California. If you're talking about early on in your career where you're going to grow and probably do better, it's going to be New York. But, I would say it depends on where you are in your life. In my 20s, it would have been New York. In my 40s, which I am now, it's probably California.
Interesting. That's really cool. Yeah, I really like California. I've been there a couple times. I surf, and working here, doing like the work from home thing, I would wake up early at like 6 a.m., but I wake up at that time anyway, so it was really easy to do that switch. I like California. All right, so you started working in New York. What did you do? What, kind of after, you just graduated, you got a job, you said that was interesting you? Like,
yeah,
what
so
job did you get? Did you go,
Goldman
Sachs, like your friends?
Yeah, so I interviewed at a lot of firms in my junior year of college. I got a couple of final rounds, and I just so happened to get lucky, and Morgan Stanley took a shot on me in investment banking. It was post 9/11, so what was really interesting post 9/11 is once the towers came down, once that tragedy occurred, a lot of the insurance companies that had to insure the towers actually all went out of business. And so there was just a lot of activity in the insurance space. A lot of new companies had to be started to insure people and things like that. And ultimately that created this demand for investment banking. And Morgan Stanley needed analysts. And, I interviewed a few times. I was first put on the wait list. Ultimately that came through, and I took the job, and I came to New York working 100-hour weeks in the investment banking group, which was tiring but amazing.
That's cool. Do you have like the Series 66, Series 7?
No. So as an analyst, you're not required to do that. When you get to an associate or VP, you did. Because I never ended up going past an analyst level, I didn't have to get that. I didn't have to get those licenses, certifications. Yeah. And then on the buy side, you don't need that stuff, because those licenses are designed to train people who are ultimately going to sell securities to people. As an analyst, you don't do that, and then when you kind of go, when you go to the buy side, you're not engaged in selling.
Got it. Okay, that makes sense. Cool. So I guess like that was 2001.
Yeah, 2002. Yeah.
Okay, 2000. Oh, after the
Yeah.
fair
So I
enough.
did that. So I did investment banking from 2002 to 2004. From there, I moved over to the buy side. I got a job in private equity, working at a firm called Warburg Pincus. Turned that into an opportunity at Elevation in California, actually, in Menlo Park. I was just out of Northern California. So I initially started doing insurance, and then from there I transitioned to technology buyouts. We were buying relatively small companies, $200 to $500 million companies, and yeah, that turned out to be a big part of my my existence.
That's very cool. Okay, so you're on the buy side. Then technology, I guess that was a good time. Or like, well, you're after the 2000 boom. So
Yeah,
was
so-
it the?
Yeah, no, great.
Did it take a while to rally?
It's a good question. So tech goes through this just incredible, exuberant phase from 1998 to 2000, 1997, 2000. It comes crashing down in 2000, much like we saw last year. And then, yeah, it's basically in the doldrums for the next 3 to 4 years. And what ends up when I get into the sector, it's getting somewhat popular again. And you could still buy technology companies really cheap. So the timing was good. And then, yeah, look, it literally did kind of go on a, I guess, 16, 17, 18-year streak. So, yeah, look, timing's kind of everything in this industry. It's less about being smart sometimes. It's more about being lucky. And I've been incredibly lucky. So I would say that's worked a lot.
I'm a strong believer that luck, you make your own luck.
There's a guy, Max Kellerman, who says luck is a residue of design. I agree with that. There's a lot of truism to that, but at the end of the day, like,
they also say if a monkey threw money at the stock market back in 2000 and now it would be worth a lot more.
Yeah, but then when you look at that and you think about that for a second, a lot of managers, a lot of people that run money don't really outperform the markets. So while we think that's true, it's not totally true. But look, I'll tell you, when you're young, when you're kind of going through the decision making between this firm versus that firm, this opportunity versus that firm, the margin of error is actually very thin, and ultimately there's a lot of variables that are out of your control. Who do you end up working with? What decisions does he make? Do those decisions end up making a lot of money? Do they make the firm successful? Does he leave? Does the firm get taken over? Like, there's so many things that can happen that, when you're an analyst or an associate at a junior level, you can't control those things. But they have material implications for where your life will go from there. I'll give you the story. I had a friend, brilliant guy, worked at Blackstone. He finishes his third year at Blackstone. And he has 2 offers. One is the $6 billion firm, hedge fund, and the other one's the $15 billion hedge fund. So
15 million versus 6 billion?
6 billion versus 15 billion.
Oh,
so
geez.
they're both very successful hedge funds.
Yeah, it's big.
But if you looked at the surface, you would have said, look, you're going to go to the $15 billion one, right? It's 2.5 times bigger.
I agree.
And that had less people and was paying him more money.
That sounds like...
So he's not sure what to do. He sits down, he interviews with both the firms. Sits down and interviews with the CEO of each firm, CIO, the Chief Investment Officer.
Okay.
And he sits down with the $15 billion one, and the guy goes, I'm really interested. It's 2007. And the guy goes, I love energy. I love commodities. I think, we're in the super cycle. We've done so much work on these companies like Freeport, McMoran. And so I just think that we're going to be in this market forever, and we need to be exposed to that theme. My friend hears him and goes, okay, leaves. Doesn't feel great about it. He meets the $6 billion guy, and that guy goes to him and goes, yeah, look, I hope the market keeps going up. I'm not totally excited about it. I think we made a lot of money. I'm going to try to keep making a lot of money, but I'm measured about where things go from here.
He was already suspicious about
that guy was already suspicious. So
the $6 million guy.
The $6 billion guy.
Fair enough.
So he hears those stories, and he says, look, I kind of lean with the $6 billion guy. I think there's something wrong here, whatever. Well, 08 happens. Nasdaq's down 40. S&P's down 30. Dow's down 20-something. Within another year and a half from that, the $6 billion fund is flat in 2008. The $15 billion fund is down 50.
There you go.
So that fund goes from $15 billion to $7 billion. the $6 billion fund goes to $20 billion. 2 years after that, the $15 million fund is gone. It's wiped out.
Jesus.
The $6 billion fund
That's
is
insane.
now the $6 billion fund is now a $40 billion fund, and he's one of the most senior guys there. He's worth hundreds of millions of dollars. So had he taken the path of what looked objectively as a better opportunity, he would have just jeopardized his his career would have been screwed.
Jeez.
So it's one of those things where he would have done nothing wrong taking the $15 billion job. Most of us would have done that. But because he had a bad feeling about it, he decided not to. So luck does play a big role in this.
I can see how that's a good argument. That's a good story to illustrate that. 2008. Where were you?
I was working in a hedge
you
fund.
Sold swaps.
Yeah, I know. I wasn't that lucky. I didn't have $6 million, $15 million option. So I was working in a hedge fund that was $2.5 billion. So I ended up doing private equity for 3 years. I eventually get the itch to want to be in hedge funds. I interviewed for a couple jobs. I'm lucky enough to get one. Take it, 2006. And I'm there for 2 years. And it's my first kind of foray into technology public investing. So it's really exciting, scary, call it what you will. And then I realized in 2008 that I feel like I can do this myself. I can run my own fund. I don't want to be an analyst anymore. I've been an analyst for 2 years. So I asked my mom and dad for money, and they give me some, and I leave that firm. Well, I'm kind of fired from that firm, in fairness. I wasn't always the quietest kid. I was actually really outspoken.
At the hedge fund.
Yeah, and I pissed off the PM. But it's not performance for it. I just make him mad one day.
Okay.
I tell him I'm negative. I don't know why we're not betting against some of these companies. And he's just livid with me. He fires me 2 days later. And so me and my buddy, we just started running my money.
Was that Thrax?
Yeah, no, that was actually Gamma Partners, which was before Thrax.
Oh yeah, I couldn't find anything about that. Gamma Value Fund?
Yeah.
LP?
Yeah.
Okay.
So I ended up running that money. The reason you never heard anything is it was friends and family. It never goes beyond that.
Oh, so you don't have to file anything?
Yeah, file anything. It never goes above $1 million.
Still pretty good.
It was okay. And we do really well in 08. So we're up 30% when the market's down 50 or 40 or whatever. And so we were a really good year. Yeah, we were lucky. Because we were negative. We short some companies. We bet against some stocks. We figured it out.
Did you see it before, or were you just lucky? You heard of everyone was just doing it, or were you
a bit of both?
Okay.
It was a mix.
You found
I don't want to say that I'm the Big Short, Michael Burry type pioneer. I didn't see that. I did not see that early enough. But once it was clear that things were going bad, we figured it out pretty quickly. It got pretty negative. So, I would say that about markets. What people don't really understand is and it took me a long time to realize this. I didn't appreciate this in my 20s or my 30s. What I do appreciate today is, markets give you time. If you're willing to be a little patient, whatever, you're getting another opportunity on almost anything you look at. Very few times do stocks just kind of run away from you one way or the other. And being mindful of that is super important to me.
I definitely saw that. I remember specifically in 2020 when COVID started hitting. I can't remember if it started hitting New York, and people started getting cases. And I remember at my job, and I was like, this thing is just gonna tank. The whole market, there's so much fear right now, and everyone was starting to go to their work from home, and people were like, yeah, maybe we should go to the office. I was like, dude, this is bound to something is bound to happen. Okay, so 08. Tell me more about Gamma Value. So you raised money from your family, and they were happy to give it to you because they had seen
No, they just gave it to me. They weren't happy to.
Fair.
But they did it.
You pried it out of their hands.
Yeah, pretty much. I kind of pried it out of their dead hands. Not dead hands, but.
Oh no, I'm sorry.
No, they weren't dead. No, it was hard. They didn't want to give me it.
Okay.
But they did. They believed in me and they loved me. It was really my mom and dad. No one else gave me money. In my family.
Okay. You don't have to go ask friends and family.
I tried. No one said yes.
So. Oh shit.
That's kind of what it is. Yeah.
Okay.
It was okay.
You would have rather done that than take a loan because loans would have been too high interest rates, or.
Well, no wait.
Oh yeah. Okay.
There were no loans.
There's no money.
Dude,
okay.
you couldn't get your American Express card. You couldn't use the I remember once I went on a trip to California to meet some investors or prospective investors, and my American Express stops were working.
No way.
And I'm I'm not even behind my payments. Look, we're just cutting off credit for everybody.
Fair enough.
It's a great credit card. Yeah, it's just a disaster.
Nice. Cool. So tell me more about Thrax Capital and so you did Gamma Value. Did you go back into the professional setting, or did you go straight to Thrax Capital?
So I do Gamma. I just end up not being able to raise money. It's 08, 09. It's a tough time. I'm also really young and probably a little bit brash and probably arrogant. So I can't really raise money. But a couple of people noticed my performance. I'm super impressed by it.
The IRS?
Huh?
The IRS?
No, IRS is good. Luckily I pay my taxes. But other hedge funds see it. One in particular is looking for a person to help run a tech portfolio.
Okay.
And so I take a job with him. And so my analyst and I go over and start working for this guy who has a bunch of personal wealth. And, we end up doing that for the better part of 2-3 years. Ultimately, I parlayed that into a job at Millennium, running money for them. Millennium is the $50 billion hedge fund.
Yeah, I saw that. That's huge.
So I do that. And then it's once that opportunity ends, whereas I started looking at building Thrax.
Fair enough. Did you keep your team of analysts, or those are your friends?
I only had one. And no, for the most part, I've kind of always turned over my analysts. Not big choice necessarily, but because, when funds blow up, it's hard to retain the relationships. It just doesn't work out as well as you'd hope. So, not always, but sometimes.
Yeah, I guess that makes sense. Wait, funds blow up? Has that happened to you many times?
You mean my fund blowing up, or
fund Millennial, or where you just said funds blew up?
I just said when funds go under is what I meant to say.
Yeah.
So when funds do blow up or do close down or something like that, the relationships are hard. Oh.
Have you
Look, when I wound down Gamma Value Fund, I wound down. It was it became something different than what it was supposed to be, and that just ultimately becomes a harder relationship. We had failed because we didn't become $1 billion fund. It was just merged into somebody else. So no is the answer. With Millennium, I did hit a drawdown. That fund did shut down. The money I ran, they did pull it. And so I guess I have had a few. In fairness, I think that's right.
No, that's super interesting. I've never.
Yeah, it's true. But I have.
I'm a big fan of mistakes. I think if you're learning, I don't see. I mean, obviously it's money and it's big numbers and stuff like that. But
right.
I mean, at the end of
the
day,
it's humbling. You fail a lot in this industry, and ultimately when you fail, hopefully you learn. But yeah, no, it's a life lesson almost always.
That's incredible. Okay, so Thrax Capital. Yeah, tell me. So how was that? So you said you started with your friend. What was it? I actually know. I knew his name and then I forgot it now.
Nathan Siga?
The guy from Boston. Thrax Capital? No, maybe I'm mixing up.
I don't think I started with someone from Boston.
Okay.
I did start with someone from Texas.
Oh, maybe that's what it was.
Nathan Siga. So I do launch Thrax Management. I'm lucky enough to get money from a New York State pension fund. They give me $50 million startup capital.
15 million?
50.
50 million.
Yeah, they launched 50, and then another fund in New York gives me another 40.
So you have a good
starting point.
At that point, but you have a reputation as well. You're
yeah, I mean, I launched with almost 100 million. It's a great launch, and we just started running money. And we have a really strong 2015, a very tough 2016. And then 2017, in my arrogance or whatever, I just shut it down. I didn't want to run people's money. I felt like I was better than that. And I wanted to I really wanted to run a very high-risk strategy. I didn't appreciate the value in running a low-risk strategy. And so I created this tremendous volatility that a lot of investors weren't comfortable with, which in fairness has made my career since then more challenging. Because look, at the end of the day, what I never really appreciated in the industry is people don't like volatility as much as you think. Volatility
risk tolerance. Not everyone has great
risk tolerance. It's risk tolerance. It's also just, when money is a very raw thing. The emotional attachment people have to money, the struggle they have when they're down on their money. There's a very raw set of emotions that come into that. And people really, people when they have money are less focused on what they can make and more focused on how much they can lose. And I don't think I've really appreciated that. I've
Yeah,
always
I've seen
run my life as like,
Oh my
goal
God.
should be to play as hard as possible. But I think what you realize when you invest, and when you look at investors, that's not how they think. Their goal is if they have $20 million, they don't want $20 million to become 10. If I have $20 million, my only goal is to make 20, 50. And
Yeah.
I've just never had that mindset. And I didn't really appreciate that at the time, but I do now. But back then I was just way more arrogant about it. And though at Millennium, I just took on too much risk, and that's why I lost my job at Millennium. At Thrax, the investors were uncomfortable with my level of risk, and so I was kind of the opinion of like, well, fuck them, I'm just going to do it my own way. I'd say today I definitely have a much more...
discretionary trades anyway. It's like, do what you want.
Well, I mean, when you run a fund, it's your option. You can do whatever you want. Yeah, sure. If you're a Millennium, no. That's why I got fired from Millennium.
Fair enough. Okay, so risk. But after that, were you doing
I ran my own
Mass
money.
Ave?
Yeah, so I did my own money. After Thrax, I ran my own money for a while. I had a family member that was sick, so she ended up being better. But ultimately, that distracted me a little bit.
Wait, sorry, say that again?
I had a family member that got sick.
Oh, I'm sorry about
That's
that.
okay. They're fine now. But that distracted me a little bit from...
Yeah, I can understand.
And so I took a bit of a hiatus. Came back in 2018, started looking for a job. Took me about 9 months to get one. Ended up at a firm called Wexford Capital, which was a energy and equities firm.
More conservative.
They were conservative with other states. They were conservative when it came to leverage. They weren't necessarily conservative when it came to investments. And ultimately during COVID, we found out in March of 20 is that they were incredibly long oil. And oil went down so much, they lost like 80%.
Oh, I was going to say, like, now that's great energy.
Yeah, but back then it wasn't.
That was when it was.
So they lost a lot of money, yeah.
They were paying tankers and.
That's right.
Yeah, okay.
So they got killed. They got smoked.
Jesus.
And so, ultimately the TMT team there ended up starting in a smaller firm called Hampton Road Capital, which
Okay.
can be called JT, run by a guy named John Thaler, who's very bright, but can be tougher to work with than others. And I went to work there. Ultimately, I left that firm to look for another job. And then in March of 22, I came up with Mass Avenue. So that was the story of Mass Avenue. I'd only been there a year and change when all this stuff at Mass Avenue hit the fan.
Well, I haven't followed at all. What are they going under? Or?
Yeah.
Oh,
Shut
jeez.
Yeah.
Oh no, they had.
There's an article on Reuters.
They had
Look
big
in Reuters.
positions in Silicon Valley Bank and.
No,
Credit
they were
Suisse.
actually short that because it was my recommendation.
Oh no.
No, the founder committed some
Some
very
questionable accounting.
very heavy compliance violations. You'll see if you Google Mass Avenue and
I'll find that.
redemptions, you'll find it.
Okay.
So I won't opine too much on it other than say that
All good.
he absolutely did some of the most unethical things we've ever seen. And ultimately those were met with just some dire consequences, which is investors leaving.
Fair enough. Cool. So, thanks so much for that. Do you want to tell me a bit about your? So we've gathered that your investment style is like you like volatility a lot. You don't
Leverage.
mind leverage. You don't mind taking on big risk. What's your? I mean, we said like equity. What's your? I don't know. What's your investing strategy? How would you describe? For example, if I was saying like Warren Buffett's investing strategy is like very value investing. He's doing long on whatever those 6 companies are, like Apple,
Yeah.
Bank of America, because he sees like strong fundamental growth. Those are the companies in his backyard or whatever. What's Sheetal Duggal's?
Yeah, I would say it's just about. I'm pretty agnostic to the style. I just want to find ideas that I think are compelling. So it's very much a absolute return strategy where I'm looking to find the best ideas and create that portfolio. And if that means that all my ideas are short ideas, so be it. If it means all of them are long ideas, so be it. The money I'm running is mostly my own. And so I'm kind of just like, well, I want to make as much money as I can for myself. As a result, I want to find the best ideas possible. If those are value ideas, so be it. If they're growth ideas, okay, that's okay. If they're Warren Buffett ideas, that's fine too. I don't care where the idea comes from. I don't care who else owns the idea. What I care are 2 things. One is, can this idea make me a ton of money? And by that I mean 30, 40, 50, 60%. And 2, can I have a differentiated view on this idea? Or at least agree with the differentiated view on the idea? Meaning, can I find conviction or a view that's unique to the investment thesis, and my experience, my background, my network, whatever, gives me access to information on this idea that maybe other people don't have free access to, even if the access is always available for everybody.
Cool. So max alpha and like contrarian total, or well, I guess not contrarian, but like unique and extremely rare.
Yeah.
I guess that makes sense. Short term or long term, or does it not matter? I guess like because you're saying 30, 40, 50%, but over how long?
They matter. I mean, even to make any kind of real money, you have to consider the fact that it's going to take time. Like, you know, time is this incredibly valuable, but also very difficult thing to deal with. So I would say that super important to just, if you're going to go down that path or whatever, you need to be mindful of the time thing.
Okay. Fair enough. Like, I think, for example, I know a lot of books I've read, like all of these guys, the kind of sit and hold investors, they're saying that real money, you make it by sitting. Are you more like, I want like, you know, ride Tesla from 0 to whatever it is now, and like, or well, actually now it's terrible, but like, you know, you don't mind if it's short-term growth, and you do that over half a year or whatever, and short it on the way down.
Yeah, I don't know. I mean, it's hard to say, right? Like, I mean, you're asking about Horizon, right?
Like, time horizon.
I mean, horizons can change. They're malleable. They depend on a few factors, right? Like, maybe the stock gets to your target price very quickly. Maybe the thesis changes. Maybe it gets better. Maybe they had a product. Maybe they had a management team. It's like there's so many things that'll change your horizon on investment. So I think the real question is, do you have an absolute view on what you can make on this thing, and are you getting closer to that view? And are you getting closer and closer to that realization? If you're not, then you think about it much more thoughtfully than anything else.
Okay, all right. So how about this? So I know you said like you don't like people who are like questioning how much do they lose. What's your, for example, I know William O'Neill says like cut your losses at 7 to 10%. Do you cut your losses? Are you?
If I did, I wouldn't have been fired from all my firms. So
okay.
No, I don't.
So you have no.
I rely more on my instinct and my conviction than I do on whatever broken or P&L sells me.
Okay, so you'll sit on your thing until it goes up.
Yes.
Okay, fair enough. Is the market still in a bubble, or I don't know?
I mean, so I don't think the market's necessarily in a bubble, even though that's a word I've used. I think what I'd say about the market is, there is 20 years ago, information didn't flow as quickly to people. It just didn't flow as fast. The internet has changed all that. Social media has made it even faster. As a result, creating variant and differentiated views is how you make money in investing. Right now, people are incredibly negative on the world, on the economy. It's actually, you'll read it on CNBC, you see it in the Wall Street Journal. That is how people think. Now, if you took a step back, there's a lot of reasons behind it. So then the natural question is, how is the market up this year when the news and tenor of news is negative? And I'd say that the market is not necessarily in a bubble, but it is hopeful that whatever we're seeing happen right now in the economy is going to be slowly will go away. Like all the issues.
Soft landing.
Soft landing. Fed will accommodate us.
Which they've been doing until now. They've been stopping since 2008. All of the these bank crash, boom, they were there right a little too close to home.
So Ben Bernanke was called Helicopter Ben because he would just drop money from the sky.
Fair enough. I need that.
And Janet Yellen was as dovish as they get. So absolutely, our Fed chairmans for the last 15 years have been incredibly accommodative central bankers. The problem is, and that was fine because what happened in 2008 was there was so much leverage in the system that when it deflated, it created just tremendous amounts of pressure on asset prices. Because we'd all there's been such a subprime housing bubble, housing was in such a bubble. As housing deflated, which is such a big part of the economy, real estate, everything else was allowed to kind of inflate and reflate, and that's why tech went crazy. Now that's normalized, and so what you're seeing happen, and this is what the problem is, you're living in a world where inflation is a real theme, and it doesn't help the Fed to cut rates if it keeps inflation high. If the cost of living goes up, I mean, think about it now, like in the last 12 to 18 months, price of dinner in Manhattan has gone up from like $20 a person to $40.
It was $20 a person for dinner in Manhattan. Yeah, sure. Maybe like 50 years ago.
Depends on where you eat. But it's doubled. But however you ate, if you spend $20, you're not spending $40. If you spend $40, you're not spending $80.
Yeah, inflation is entrenched.
It's insane. And what you'll find with history is when companies raise prices, they don't give you back. They don't cut prices quickly. It's a slower process.
As we were saying about Chipotle and the $16 burrito, I had that the other, like, not too long ago, and I was mind blown. I was like, wait, that's not the price. Like, how can you have a $16 burrito?
But that's what it is. I mean, it's $13.95 starting, and
I don't buy pizza. I stopped pizza. I used to do pizza like pretty often, like Fridays, and it's $30 a pizza. Like, what? That's insane. Like,
yeah. And that's kind of the world we live in now, and that in and of itself has tremendous implications for how you think about policy and things like that. So I think the point I'd make is, rather than say the market's in a bubble, which I do believe that there is this level of hope and belief the market will be okay, that's probably a little bit more misguided. I would say more broadly, the market is going to be, it's got some real challenges going forward, and I'm not sure how they kind of overcome those challenges.
So, yeah, that's interesting. Looking forward, so in the past, like, recessions have had, the recession starts, like, but the market has already bottomed. Yeah. So the market and the stock market and the economy are not the same. When you're talking about, like, a soft landing and things like that, are you talking about the economy or the market? Like, for you,
the economy.
Okay, and
so your point, what you just said, is an incredibly interesting point. For 200 years with markets, because information flowed less frequently and it reached the market more slowly, the economy used to dictate what the market did. Now, Soros has this theory he came up with about 15 years ago called reflexivity. The market can almost turn the economy the way it wants to. The market goes down, the economy will go down. And that's different than what we saw historically. So what that means is the implications of that are trying to figure out where the bottom is versus the economy, and when the economy will recover, is not as easy as we think, and it's not as linear or straightforward. And so most likely what's going to happen is the economy is going to do what it's going to do, and the market's just going to be incredibly more volatile. And I want to take a step back on this volatility point for a second. Pre the financial crisis in 2008, the U.S. had a debt issue, but it wasn't anywhere near the debt issue today. We have accumulated more and more debt. Well, think about it this way. If you buy a house and you put down, and let's just say it's $1 million house, and you put down $800,000 of cash, so you only have $200,000 mortgage. And so tomorrow, like the mortgage, tomorrow so you pay $200,000. Let's say you paid 4% on that. So on a $200,000 mortgage, you're paying $8,000 a year. Not a crazy number, right? Okay. So you're paying $8,000 a year on a $200,000 mortgage. It doesn't change your life very much if tomorrow that 4% goes to like 6%. It's now like a $12,000. So yeah, it went up $4,000, but in the grand scheme of things, that's like $300-$400 a month. It's not crazy. Okay, let's change the analogy. Let's just say for $1 million house, you put down $200,000 and you took an $800,000 mortgage. And on the $800,000 mortgage, you were paying 4%, $32,000. But tomorrow you have to pay 6%, $48,000.
Yeah.
My point is, like, the U.S. economy, global economies have taken on more debt, should create more volatility, which means we're going to go between things looking hopeless and things looking hopeful, and stock markets moving and much more violent than we've ever seen historically.
I think I'm a little lost on your point.
I'm making the point that ultimately, when you put more debt on something, it becomes more volatile. And when prices change more, it becomes more difficult to manage. So if you take on more debt as a person tomorrow, Charlie, you're going to have more risk on a day-to-day basis, and you're more vulnerable to rates going up or rates going down. So your life becomes more volatile.
Okay, that makes sense.
And what I'm saying is, right now with like the Fed and these governments, is like, look, the range of outcomes becomes more broad when there's more debt. Like someone's portfolio, when you've probably heard the statement, less debt means more stability. People always have said, pay off your debts. Don't have too much debt. Because you don't want to be stuck with the obligations if things go wrong, whatever. So what we've done in the last 15 years is just put on more and more debt, which inherently is going to create more and more of an interest income burden. And that interest expense that we're going to have to pay, interest not income, not interest expense. So we have to pay more and more interest, which means we are just fixed on higher obligations. So you're just drowning that. It's like when you go to law school and you take out $200,000 in loans to be a lawyer, or med school with $200,000 in loans to be a doctor, versus somebody who went into finance and took out no loans. Who has more of a debt burden, and whose life is living under more volatility? First one, more debt.
Yeah. Okay. Haven't they just raised the debt ceiling like in the past? Do they just keep raising it? Isn't that one of those things that's just infinite?
Sure. So you can keep raising the debt ceiling, and that's fine. But that's the equivalent of going to your bank and saying, "Look, can you just extend my credit line? Okay, I'm at 12,000. I can give you 15. Okay, sure, sir. Give me 20. Yeah, sure. 25. Yeah." So ultimately, the ability to raise the debt ceiling is predicated upon the confidence and the faith in the U.S. And right now, that's not in jeopardy. So you're right. You're right on that point. But that doesn't mean that every time you take on more debt, your bank's not just looking at you like, "Well, okay, we're gonna give this guy more credit, but how comfortable are we with this guy?" So while it doesn't necessarily impact the ability for the United States to continue to function, or you to continue to function, because they're going to give it to you, it doesn't mean it doesn't stand out in terms of how they're going to think about going forward.
Yeah, I guess I'm curious. Okay, so if they're moving forward, so they're just going to be more strict about credit.
It just means that things are just going to
be
move
harder to make money.
Yeah, exactly.
Or just like slower growth. Or yeah, I guess I don't know, because so far the market is moving sideways. Is that not similar to like what happened in 2002, 2003?
Just depends on what you think about valuation. I mean, in 2003, markets were incredibly depressed and had been down between 30, 50, 60, 70%, depending on what asset class and what subsector we were talking about. Today,
are we down like 25% or like 14 or something? Yeah.
So you can argue that's enough. You could argue that's something near what we saw in 2008, 2000. It just depends on what you think it's worth. Do you think the market, like, if I told you you could make 5% just putting your money in
bonds?
In
please.
bonds.
I'd rather die.
Would you rather do that? But would you rather do that than make like 6% stocks that can go down?
Yeah,
20?
fair enough.
It kind of depends on what your appetite. It depends on what your time horizon is, but it also kind of depends on how would you really want to do that. Do you really want to take that kind of risk? Historically, stocks have had a yield anywhere between 3 to 4% more than bonds to be interesting. So if you're going to make 5% on bonds, you need to make 8 to 9% on stocks. Right now, you're only making 6.
Yeah, I think there's been a lot of, I don't know, in terms of like stocks, like just last week there's a bunch of stocks that just rocketed. I really like the biotech pharma, like Intuitive Surgical. That's like a pretty solid company in terms of like fundamentals and stuff like that. It jumped 10% on its earnings.
Yeah.
All next week, I don't know, for me I'm seeing like 6%. I feel like didn't the S&P 500 average 11%? And there's just like a couple of years that are down, like whatever, a couple of years that are down, but then the rest is on average 11%. So like for me, it's really conservative to say, it's not conservative, it's just like saying that it's going to go 6%. Seems
But
like,
it's at 6%, what I'm saying.
it's what?
It's at 6%.
It's at 6%.
That's the multiple.
Fair enough. Yeah.
If it goes up more, it'll be at 5%. It'll be the same yield as bonds.
Yeah, so in that case, it's worth doing bonds because at least you don't have the risk that you're not going to get your money back.
Right. Exactly.
Fair enough. Tell me about, I don't know, like what's an interesting sector right now for you?
I don't think there's one specific sector that's interesting on the long side. I think most sectors are idiosyncratic. They're like ideas and everything. Like there are some software companies that are interesting. There's some such situations that are interesting. I've talked about News Corp in my podcast. It kind of just depends on the individual idea than it does anything else. Like I think EDR, which is buying World Wrestling Entertainment, Endeavor Group, UFC is merging with wrestling with WWE. I think that's actually kind of interesting. So there are interesting ideas here and there. It just kind of depends on what what your appetite is for risk. But I don't think in general any one sector is that specifically interesting. I think AI is super interesting as a long-term theme. I think all the stocks are very stretched right now. I don't really believe in paying what they're asking me to pay for these stocks, even though I think the longer-term growth is real.
Crypto. What do you think about crypto? You like Bitcoin? You have Bitcoin?
No, I'm pretty negative on crypto.
Okay.
I hope it works. I think it will work longer term. I think right now it's just got way too many difficult actors, way too many shady actors, and so when you're living in a world where like there's just so much corruption, it's hard for a stock to work, and there's a lot of regulation coming. I don't see how those two things make a interesting asset class. But I think long term it'll be fine. Near term, I'm pretty worried. I think it's a very manipulated security. I don't think it's based on. I think it needs a more regulated, accepted framework. I think once that happens, it'll be very interesting to be long it. I just don't think we're there yet.
Fair enough. Okay, so what happened? Because you said before you were doing technology. Now, do you care about technology or?
I love technology. I'm short a lot of technology.
Okay.
So. Yeah, look, I think technology is really interesting. I think there are companies that were exposed to financial services firms like Silicon Valley Bank that are going to see real struggles. I think there are software companies, hardware companies that saw incredible amounts of demand through COVID that are now seeing that kind of hangover come to life, and they're seeing less growth. I think the consumer has seen this really interesting renaissance over the last kind of 2-3 years where savings went up because the government was funding them and they were able to keep their existing jobs, and I think a lot of that's changing because unemployment's increasing. So I love tech because I think there's a lot of friction and volatility in tech, and I want to be in that because I think that's how you make a lot of money.
Fair enough. That's good. What do you look up to investors? Is there a book? Like, what were your favorite investing books? Did you read investing books?
I read a couple. My favorite one's More Money Than God. It's by an author named Sebastian Mallaby. It talks about the rise of hedge funds. It covers Soros, Tiger, SAC, Steve Cohen. It's 400 pages. I've read it 100 times. I read Barbados the Gate. Love that book as well. Those are my two favorites. Monkey Business, which is two investment bankers at DOJ, which ended up becoming merged by Credit Suisse.
Okay.
That's about their life. I mean, those books are entertaining, they're funny, they're interesting, and they give you an insight into people that I really admire. Like, I think I've said, Stan Druckenmiller is probably my hero in terms of investors. I think he's the best of all time. I don't think anyone's better than him, and so when he talks, I listen. So anytime he's in an interview on CNBC or he's written something or he's given an interview speech, I listen to it. But yeah, those books I think are incredible, and that More Money Than God documents the journey of hedge funds from like the early stages of the 1900s to today, and the story, the way it's written, and the way they think about it's just incredible. It's an amazing story.
Fair enough. I've not heard of either these
More
three
Money
books.
Than God is a read. You gotta read it.
More Money Than God.
It's just a fun book.
I'll put it on right now on my reading list. I'm reading right now. It's called Reminiscence of a Stock Operator.
Yeah, cancel it. Go read More Money Than God.
Really?
Yeah. It's
and then after I have Ray Dalio's The Nation's.
Those books are great. I would tell you More Money Than God is better.
Okay. I'll check that. Cool. All right. I guess we can call it. Let's see what I think. I have tons of stuff. Like I can probably do something with this.